Morning, everyone. Thank you to the entire GFF team for having us here. And it's truly a privilege to be at the Global Fintech Fest in, I think, the world's fastest growing and most exciting fintech market. I do believe that India's capital market story is not just a story about technology. It's a story of trust at very large scale. A capital market that has crossed 600 lakh crores in market capitalization, more than 15 crore demat accounts, 75 lakh crore plus of mutual fund assets, 110 crore UPI transactions every month. And these numbers show both reach and responsibility. Regulators like SEBI have been global pioneers, from UPI-based onboarding to the innovation sandbox, to the recent Parva, building an ecosystem today that allows startups, investors, and innovators to grow together. But what is fintech really? It's not just about growth. It's also about inclusion, suitability, and trustworthy growth. In the next 35 to 40 minutes, I'm hoping to explore with our panelists across the capital markets spectrum these themes: inclusion, education, innovation, and regulation. And we do this in the backdrop of a world where AI is rewriting the rules every day, sometimes faster than we can regulate them. So welcome, panelists and gentlemen. And let me kick it off right away by starting with the theme of inclusion. I think we've seen impressive gains in basic financial success, millions of bank accounts opened, fintech adoption soaring. But access doesn't necessarily mean active participation. If you take the striking example of a SEBI survey, nearly 2/3 of households are aware of market products, but maybe 1 in 10 of them actually invest. And the real inclusion challenge now we have is depth, especially in India's smaller cities. And Ambarish, I'm going to turn the first question to you, that what do we need to do to deepen participation in smaller cities? Is it more vernacular content? Is it simplified journeys? Is it local ticket investing? Is it anything else?
Thanks, Radhika, and thank you for having me here. The participation is actually real beyond even the numbers that you mentioned. I don't know if you guys know, but the smaller cities are contributing more than 65% of the internet growth these days. This smartphones and beyond tier 2 cities are growing at 20% year over year. And so there is real penetration happening, but even in equity markets, there is real penetration, because if you see new registration, this is NSE data. So new registrations, 52% of new registrations that are coming today are coming from beyond the top 5 states. Total registrations, if you see that, 52% are from beyond top 5 states. 55% are the new ones that are coming. So it's growing, actually, that penetration is growing. But there's a long way to go. We were talking about equity penetration. Very little, right? I mean, there's like 50% in real estate, 15% in gold, 15% in FD. So there's a long way to go. And I think the things that matter a lot, Radhika, in fact, the first word that you said today, which was trust, is probably the most important thing. When it is a matter of money, and I'm giving my money for investing and saying, will it grow? And that is true in any fintech business, but especially in tier 2, 3 and beyond, trust is going to be really, really important. What SEBI is doing, what regulators are doing, really does make a difference. But I think more needs to be done. Whenever we see any element breaking that trust, we want to see that really, made an example of in a big way in my mind, that if you see anybody breaking that trust, that's a really important thing. So trust is really important. You mentioned Indic languages. I think they're important, but there are 2 parts to it. There is one part which is educational and content. There the Indic languages are really important, because if you are educating a customer, if you are you have some content for them, Indic languages are super important. If you throw an error, Indic languages are important. But in a transactional setting, not so much, because they get used to the transaction and then that gets through. So the Indic languages have a role to play. Education has a very large role to play, because I send out this email, as the CEO of Angel One, anybody who joins Angel One, I'll send out an email saying welcome and just talk about it. And many times people say, hey, what should I do now? What do I do next? And even though we have educational content, I think not enough to educate them in the right way, tell them about power of creating wealth, power of compounding, what happens with just 10% compounding over 30 years. So education is really important, and if you get it right, I think it's a pretty big deal. The next thing I'd say is simplicity, especially as you go beyond. If you throw a lot of things at them, I spent a bunch of time at Google, so I think if you look at Google search, you just see like a search box forever. So I think how do we make our products simple is really, really critical. And last but not the least, I'd say there is a journey that they go through, and how do you create that journey? How do you provide them the right vehicle in this journey and say this is the right vehicle for you, and then navigate them through this journey? All of these are very simple to say, but somebody very wise said it's very complicated to build a simple product. So how do you productize it is essentially the golden thing that if we get to will make a big difference.
And I'm going to pick up on some of these themes, but I wanted to take that element of trust and move to Sandeep, because there's a lot of debate about distribution, and a core aspect of trust is advice. And I do believe advice is a very important part of inclusion. Now, some argue that physical distribution is the right answer. How do you see, and I know the Deserve model, how do you see the role of advice evolving? Blending digital and physical advice. Is it high touch? Is it high trust?
Radhika, and then I'm going to tie in a couple of things that you mentioned and also what Ambarish said, right? At one level, inclusion needs to happen in the sense of access. Like more individuals, more hardworking wealth creators in India need to be able to access the capital markets. I think a lot of great work has happened there. I think on the second axis of inclusion needs to be around understanding, peace of mind, comfort, hand-holding. And I think that's one area where our industry needs to do a lot more work. We are seeing the regulator has stepped forward in terms of enabling regulations, but I think the work that we are needing to do is almost build trust, build comfort. Now, how does that happen in this environment? We are speaking at the GFF. Fintech is the operating term here. The assumption is that there is a digital savvy customer which the fintech community is serving. Yeah. I think to make more people digitally savvy, the point that Ambarish mentioned needs to happen. Products need to become better to be able to offer better hand-holding and the sense of advice. So I think the real work needs to happen at the intersection of understanding the customer and building digital product in a way that we can help them. Now, in this context, what is the role of the human person? The RM, the physical touch, as you mentioned, I think that's very important to complement what technology is not yet able to do, right? Can my digital platform listen to the customer? I think one of the biggest issues that customers have is nobody's really listening to what I have to say. Everyone is talking to me. They're talking about products. They're talking down to me. I think that's one area where the human element is still very important. Technology plays a big role in enabling this human element and also governing the human element, right? So how do we avoid mis-selling? How do we ensure we are able to track what this human person is able to communicate to clients? Is that right in the context of their portfolio? Is there a sense of oversell that is happening? Is there a sense of missell that's happening? Those are elements where technology and fintech have a role to play.
So since both of you talked about the right way to sell, suitability, I'm going to enjoy the privilege of being a moderator and now ask some tough questions about suitability to my fellow mutual fund colleagues. And since I'm the moderator, I don't have to answer some of these tough questions. But I think it's a real issue. You know, we talk about the number of demat accounts, we talk about the number of folios, but you look at a few stats again. The average SIP lasts about 3.5 years. 40% of first-time investors exit within a year. And it's interesting that in 2024, there was a SEBI survey that found out that, and it doesn't surprise me, 40% of young investors rely on social media for financial decisions, often without even verifying the source. So the next phase of inclusion has to focus on suitability. And Srini, maybe I can start with you and then move on to Kalpen. you know, with gamified apps, influencer-driven content, a lot of new young investors, are we building good investors or are we building speculators? And how do fund houses, all of us, balance engagement with responsibility? How do you see your marketing evolve?
It's a fantastic question because we've been grappling with this, and I think you brought in a very interesting data point, Radhika, about stickiness of our investors. It goes down to the root of what is happening today in the industry, which is the experience is being mixed. There are investors who come over and over again, buy multiple products. There are investors in our own fundos who have more than 7-8 products, and there are investors who have one investment and they don't even stick for more than a year. It clearly goes back to saying how did they get in, what advice did they get when they got in, and what kind of handholding did they get in period of volatility, in period of any other experience that they wanted to do. So there is no perfect science to it. I think the best way to go through this is to, I think all of us at fund house level and our distribution community are working on this whole stickiness. Industry for many years have been talking about why long-term investing makes sense. We have so many campaigns that's running around it. But fundamentally, human mind is very short-term in nature. So I think there is a lot of these experience building that needs to happen. One good cycle people go through, wealth is getting created. There's a little bit of patience that we need to also have in how the wealth gets created, the experience that gets benefited. And the top of it, I think what Ambarish also spoke about, Sandeep spoke about, was largely around what kind of information do we give them post-conversations, post-investments that people do. And that's still a very mixed bag today. Account statements are difficult to understand. Calculations are very tough for people to know. So it's still a very mixed bag. And nobody talks about a gold going through that volatility because one fine year it goes up and everybody's happy with the kind of written gold is coming through. So the question again is a little bit of a human science and a whole lot of experience that we need to create. And we need to be a little more patient because most of our investors who've come to the industry have been during this peak period. So any short-term volatility, there tend to be some kind of experience. So I don't have a direct answer to this. I think the best answer to this, Radhika, is probably that we be a little more patient, look at data, and suitably address that from education, from experience building around that.
Okay, so let me ask Kalpen a question. And there is something in our industry that absolutely drives me crazy, and we're talking about fintech, which is that all our platforms push top trending return funds and products. It doesn't matter whether the fund is a PSU equity fund or a Radhika Gupta is a nice person fund. And all of us are smart enough to know what that leads to. I don't even want to mention that. My specific question, Kalpen, is how can technology be used, since this is a fintech conference, to nudge better investor behavior? It could be patience, it could be diversification, it could be anything else. But how can we have technology, how can we use it to nudge better behavior?
You were waiting to ask the toughest question to me.
Absolutely.
Okay. It's one of the best questions, and with scale that tech has brought, I think it's time to think of responsibility. And we are acquiring consumers. I don't think we are acquiring investors. And the role of tech is to represent data in the most honest way and to show both the sides of the coin to our investors. We all know that in 30 years, markets have gone up and delivered 13% return. But these 13% have gone through 3 phases. A phase of 40% CAGR for 5 years, then phases of 50% drawdowns for 2-3 years, and then again phases of 0 returns for 4-5 years. When we say 13% over a long period of time, generally most communication is around the 40% up cycles. But very rarely is data represented to show the worst case returns, to show rolling return. I must compliment you for also taking this up, even in our regulatory interactions, that we need to show rolling returns, we need to show worst case 5-year returns, more importantly than the last 3 years of rising returns. After COVID, actually what's happened is, I've started my career in 1998, where there were few bull markets and most likely it was a stagnating market. Last 10 years, every correction has been shallow and everyone thinks this is a one-sided upcycle market. So I think technology needs to play the role of converting data and not just showing the good data. See, markets are volatile is the fundamental rule of investing. But I think in the quest of speed and scale and playing to the biases of human greed, most often we lure investors. So when you ask what should we do, very soon, if you guys are not following us on LinkedIn, please do that. You will see a LinkedIn post from our marketing guys to say, if we ever lure you on returns, challenge us. If some of you go back today out of Mumbai to your home cities, on the airport there's a campaign running which says, no more will I be lured by returns, no more will I buy into a product just because the CEO of a mutual fund is saying so. So we are making a lot of honest attempt to leverage, or rather to use marketing as well as technology to talk about the other side of the coin, because right now most investors are tilted on the greed side, and it's important to highlight that everything has cycles. And I'll give you a very important anecdote. You brought out a very a valuable topic that we keep talking about. 3-4 days back, and alluring to the gold cycle right now, everything is about gold and silver last few days. And I just put up a post on X saying that the best time to think of gold and silver was 1 year, 2 year or 3 years back. And I was just jokingly mentioning that my marketing and sales team, they are very poor marketers because we launched these funds 3 years back, but we could not get money. And now money has started coming. And one friend of mine, one ex-colleague of mine wrote back to me saying that you're still a bad marketer because today is the time to exploit the greed. Today is the time not to warn people about gold and silver. Why are you guys doing that? So I think here is where the sense of responsibility and leveraging both sides of the cycle, effectively showing data, showing drawdowns becomes very important. Many mutual funds, and I belong to the mutual fund Sahi Hai camp, we highlight that small caps have created immense wealth over 20-30 years, but there are periods where small caps have fallen 50-60% also. So I think if we are able to do this more collectively in scale, we will be able to create more responsible investors as well, but that responsibility starts from all of us before we tell investors to do that.
Yeah, and even though I'm not supposed to speak, my one request to anyone in the asset and wealth management and tech ecosystem, stop looking at 1 year returns. Otherwise, I will come after you. But let me move to the next topic. I think we've spoken about technology and behavior, and we should talk about the core theme of the conference, which is AI. And we've used digital nudges to think about how investors act, but AI has the potential to reshape some of that thinking. It's analyzing behavior, it's detecting risks, it's doing a lot of personalization in portfolios, and yet it's raising questions of transparency, of suitability, of why someone is recommending me something. And I often wonder who's advising the investor, a person or a program. So, Sandeep, let me come back to you and talk a little bit about how AI can enhance hand-holding and really make advice truly personal. Because every time someone comes to me, the first question they ask is, I have 30,000 rupees a month to invest. What's the best fund for me? And I think that question is only wrong. How can AI make advice less personal?
So look, I think given that it's the conference topic, I think it's very clear that the AI platformization is here to stay. It's almost like what happened with the internet era or the smartphone era. It is going to be a massive reshaping of the entire tech ecosystem, including what's happening in the investment side. Now, that said, the question is at which parts of the user journey or which parts of the service delivery model do we use AI? Can we use AI in how to create portfolios? Sure, but is that the best way to use it today? Maybe not, right? And here I think sometimes in our industry, both machine learning, which is more rules-based way of running portfolios, is confused with AI. I think in those aspects, it's probably a little early for us to start leveraging it. But there are elements where we can definitely use AI to be able to understand the customer better. Listening, for example. Like in our case, when a relationship manager is talking to the client, it's very natural in a 45-minute or a 1-hour conversation to miss nuances of interaction. Can we catch some of those nuances? Can we actually identify what are the concern areas that the client has? Suppose a client says that, look, I may need capital, I may need 5 lakh rupees 3 months down the line. It's easy for the relationship manager, among many other things, to miss it. We can catch that. We can track it, and we can use AI to ensure that we are delivering to the promise that we've laid out to the client. So I think in multiple parts of handholding, listening, tracking, and enabling the intermediary, I think there's a lot of work that we can do on AI. I think it's very early to start using it for decisioning.
Ambarish, I'm sure you have too, but over the last day and, especially at the dinner last night, I've been meeting some amazing startups and a lot of people who are 18 and 19 and 20 and, very, very young, doing some interesting work in AI. And I think the question that they're asking and, that I want to ask you is that what are a few AI use cases and applications that are really breakthrough in terms of transforming the retail investor experience? It could be discovery, it could be advice, it could be trust.
Yeah. No, thanks for the question, and I think it relates to where, Sandeep, you were ending this conversation. But the AI, I think the hype is real. It's unclear whether it's a boom or a bubble. Hopefully you guys know the difference between a boom and a bubble. Boom is where it's kind of real. You're seeing the sort of hype actually going to reality. Bubble is when you don't know, at some point it's going to come down. It's very hard to predict what it is. But I think if you see how much investment is going on, a lot of smart money is flowing in, so it's kind of real. Like I think I was reading something that in 2028, $600 billion will be spent on AI. I think that number is underestimated. It might be happening right now. I think, NVIDIA investing 100 billion in OpenAI, just like that, is crazy. So I think there's a ton happening there. In terms of use cases, I think what is happening is everybody's thinking about it, and the technology is ahead of the product here, is what I'd say. And there are tons of models, tons of interesting demos happening, but there's also, just to sober us up, there's also a report by MIT that says 95% of the companies are actually not creating value with AI. So keep in mind that as I talk about the use cases. And the critical thing when I talk about the use cases is that what exists today is a set of parts that can be brought together. Now, if you don't bring them together in the right way, it is a spare parts bin. If you bring it in the right way together, it suddenly becomes a fantastic, brilliant machinery that can do something. So how do you bring that together is the big deal. The set of use cases, I would divide it in a few ways. One big one is the human-machine interaction point of view, where you could think of either a chatbot. It seems very basic, but tell me who has the best chatbot in the world today on customer support, let's say. I don't think you will say one company there. So there is a ton to be done there, and many companies are innovating there. Now, if you take that to the next level and say, why not have a voice bot? Now, again, I don't think there's one company that says they're doing well. Lots of people are doing it. Again, the technology exists. I don't think anybody has productized it in a way that is wonderful, and any of us who does that can actually create tremendous value. So that's number one, human-machine interaction. There is tons happening in that area. What I'm super excited about and where it'll go, I don't know, is, once you get into the domain of Neuralink and quantum computing and how that happens, it could change human-machine interaction in a huge, huge way. I know you guys are all probably laughing inside saying this guy's talking about quantum and Neuralink, but this is all starting to become real in certain labs. Number two, I think I'll again go back to trust. Radhika, you mentioned, other folks have mentioned. Fraud and risk and anomaly detection, when a transaction is happening, whether it's in payments or capital markets or anywhere, how do you a priori figure out or real-time figure out that, hey, this is a risk, this is a fraudulent transaction? It seems very simple to say. It is almost impossible to do 100% of the time, but how do you get to that point where limited amount of data and interaction with the consumer, you can figure out, hey, you know what, you're going down the wrong path, there is a fraud transaction happening here. The third big area, I would say, is, and I kind of touched on it a little bit, is about how do you make things intelligent. And intelligent in a way that is useful to the consumer. For example, I actually think nobody gets up from their bed, or I hope they don't, and say, "Aaj mujhe investment karna hai, I want to invest today." They say, "Look, I have a goal in mind, I want to sort of either make money, do something, like I want to invest for 5 years because I want to get to this point." There is a reason they are doing it. Now, is there a way I can talk to an agent and say, "Hey, you know what, here's my goal. Now tell me how I can achieve this goal." Now, that goal could be about a mutual fund investment, an index ETF investment. I could decide and say, "Hey, you can invest here, and later on you can get less if you have a personal need for something else." How do you create that so that money becomes super simple? Money is really an enabler. Money by itself doesn't get us anything. And how do we create that intelligent relationship with money where it is just super simple and say, "Look, here's the money I have. Here's what I want to do with it. Here's my profile. What do I do?" Now, in all of this, now where Sandeep was going is very important. Has the time arrived or not? How regulations intersect with how do we create a safe enough environment? Because what can happen very quickly is that you can go to an AI agent, ask something and start following it, and it's not the right thing. Both from a regulatory and compliance perspective, but we not tell you the right thing. How do we, as we progress, we go down this path where machines are able to help us because, like, Sandeep said, they're able to cache things today. That's where they are. They can do sort of, "Hey, you know what, this portfolio analysis, this may be right or not." But I do think there is a world where we could get more and more intelligent. See, it's a continuum, right? Back in the day, people used to do calculations on a piece of paper. Then suddenly, you got Excels. Now you've got certain more complicated programs that are doing it. I think that continuum, when you cross, I do think there is a role for intelligence there, and creating a really intelligent platform that just simplifies this relationship with money so that I don't have to worry about money. It just becomes an enabler for me. And that's something that at least I'm looking forward to.
Since you mentioned security, I can't conclude this discussion, and I want to spend the last 10 minutes that we have talking about regulation, because I do believe mutual fund sahi hai, the size of the capital markets, we're all standing here on the back of the regulatory environment. And while we may all whine, I don't envy the job that our regulator has, because it is genuinely, in a market like us, a very fine balance between innovation and investor protection. India isn't, I don't think you can have an average of Indian. I think you have so many variations in financial literacy, in financial access, in financial readiness. And I wanted to talk about how we innovate without eroding trust. And I promised I'd ask my mutual fund colleagues the tough question, but this is a question to both Srinivas and Kalpen, and I'm hoping both of you will give me a straight answer. But we're living in an era of smart beta, SIF, fractional investing, tokenized assets, and I don't know what else is ahead of us. Now, which of these, in your view, are genuine investor solutions, and what is innovation for innovation's sake? And how do we strike that balance responsibly? And both of you have to give me an answer. You can choose who goes first.
Okay, I'll take that. Straight answer, you said. Last year we did a campaign called "Till You Find the Best Fund Manager, Just Index." And we were told that why are you taking investors towards basic indexing in spite of you being an active fund house. And 95% of our assets were in active funds. So I come from the school of thought that simplicity is very important. We are a fragmented country with, as of today, 5 crore investors. But maybe 1% of this investor base will understand some of these newer products and complex products, and the newer and complex products may fulfill the need for 100 or 200 or 500 investors, not necessarily 5, 10, 20 crore investors. The investor at large who's today joining the industry in the last 5 years digitally needs to first understand the basics of the asset class. पहले वो बीटा ही समझ ले तो बहुत बड़ी बात है, because we have realized, and as data has shown, that in the last year when 6 months between September to February and markets fell by 20%, 70-80% of SIPs of that year had started to cancel. So the first thing is investors don't like negative returns. Human beings don't like negative returns, and we have to educate that it's just part of the game first before we give them new wrappers and new vehicles. Does not mean that we do not create these new vehicles, but we have to highlight suitability and offer them to the right set of investors and not create this whole choice range into confusion. So suitability hence becomes very important, and against every product it becomes very relevant and responsible for us to say who is this not meant for. So I think the basic products first, the first block is a simple Nifty, the second block could be a hybrid fund, the third block could be a multi-asset fund before we go into PMS, AIF, so on and so forth. And we have launched a Gift City fund right now, but we are making all efforts to tell people that instead of crossing difficult hoops, there are simpler Indian fund products which can give you access to global stocks, either 100% or in a hybrid manner. Take them first before you get into more evolved products, because evolved investors or maybe very rich investors may want some complexity, but they have the wherewithal to understand them. So I think more than buyers being beware about this, it's important we highlight all the pros and cons upfront transparently, and who is this fund not for is more important to communicate than who is this fund for.
Okay, Srini, since Kalpen has skipped all the masala products, over to you.
No, I think there's some fundamental truth that choice for the sake of choice is a bad thing. Innovation for the sake of innovation is a bad thing. Having said that, I think choice kind of builds trust. Choice kind of builds a flavor. Obviously, suitability is a very important question when it comes to choice. But I think the sense of maturity of the market is around trying to build capabilities which can try and innovate on top of what's already there. As everything becomes a commodity, you need to think about what else can be done. And to be fair, while there's still a lot of penetration that needs to happen for asset managers, is still a very small number, there's a whole lot of customer base who are looking for newer choices and newer bases. And I think that's the important part. The important part is not about trying to say, hey, let me not just do more than 3 vanilla product. We will have many amount of variations of the vanilla product. The question is, how do you make it accessible, and who do you make it accessible to? And if you can get that model right, so for example, I think our industry is very smart. They don't just like that launch a product because they need another packaging. There's a lot of market research that happens, feedback that comes from distribution community, institutional investors give feedback, retail investors give feedback, and then you build products because there is economics of everything that you launch today. At the same time, we also hype up something that doesn't need to be hyped up to a particular level. So that's a balance that we need to do. Like there needs to be innovation, but the innovation doesn't have to be mass marketed. Build an innovation where the particular set of people who would need. Today in the world of AI, I think this is going to super accelerate. Right? There'll be like a choice of product for one. Right? Today you can't do that today because there is commoditized product. For many years I said you just probably need one product to build a long-term wealth, but that's not true anymore. Asset allocation has played a very critical role. My own way of looking at portfolio could be completely different way of somebody else is looking at the portfolio. One of the things AI does, and I want to just compliment some of the stuff that they say, is AI actually way to think about AI is not about what biases AI will create. The way to think about AI is what human bias will the AI remove as part of the process. If you can think through that, I think there's a lot of that stuff that will happen, and you can retailize that too when you can actually build a custom-made product to a particular use case. I think it's very much possible. Today, both regulation and the unit economics doesn't make it happen, but tomorrow that's probably possible, and technology is one way to go.
And if I could add a point of view there, I think our industry and capital markets industry, and differing a little bit from Kalpen, is also important for India's capital market development. And unfortunately, that's not going to happen if all of us run just Nifty index funds. So you need a vibrant derivatives market, and safes and arbitrage funds will do that. And you need a wide bond curve and a credit curve, and we all talk about why we don't have that. And the private credit industry will play some role. And you need sources of funding for startup capital and all the listed companies that are coming. So I think different things genuinely serve different purposes. Sandeep, I'm going to ask you to wear a different hat now, not as a wealth manager, but as a founder of a company in the asset and wealth space. And there are so many startups that have come into this space. We've also benefited from a tremendous bull market in the last few years. But it's also a fact that funding in this category has tightened post-2021. FM made some comments about how she thinks fintech needs to evolve in terms of revenue and profitability. And I think entrepreneurs are being tested on business models and on sustainability. The question is, what kind of policy and ecosystem support, it could be collab, it could be policy, it could be capital, will lead to the next phase of good quality innovation?
Radhika, it's an interesting question and something that we think about all the time, right? And if you private conversations among technology founders in the wealth ecosystem is about where is the pot of gold, because we are all still figuring a lot of stuff out. Look, I think we are very fortunate, the financialization story that's playing out in India. We are, give or take, 12 trillion in savings right now. Over the next 20, 25 years, as we become Viksit, potentially go to 100 trillion in savings, right? And there is therefore that big pot of gold in front of all of us sitting on this stage and outside, which we are chasing. The real thing is that how do we get to an economic model which makes sense along the way? And while I might say that a lot of stuff we expect from the regulator or from the government or from the customers, I think a lot of the answers are within us. How we look at capital allocation will be a big determinant of whether we get to end state profitability. One of the big challenges in our ecosystem is how do you look at capital expenditure that you do on technology, right? A lot of it is ahead of the curve. Some of it is even experimental. And that comes at the cost of raising capital. It also comes at the cost of dilution, right? So I think that's one part that I think the industry is trying to figure out. My personal view is that if you're building strong technology capabilities, these are assets that will sweat for the company, for the ecosystem in the long term. The amazing part is in India, a lot of that heavy lifting is being done by the digital public infrastructure, right? Imagine, I mean, for account aggregator to exist is such an enabler. I don't think Deserve would have the right to exist if account aggregator did not exist, right? We would not be able to deliver portfolio management services to over 200 cities sitting out of 4 locations in India if account aggregator wasn't there. And in an alternate universe where, let's say in the United States, this is a company, this is a private enterprise doing it. Here, it's a public good. Look at UPI, our ability to, as a portfolio manager, pick up capital or for clients to wire money to us without cost, without any friction, is just so powerful, right? And then you have eKYC, the ability to open accounts using video, I think is just fantastic. So I think we are in a unique situation where the digital public infrastructure is doing the capital expenditure. We have to complement it at our end to create capabilities that leverage it, and hence be able to create models that work for us.
So Ambarish, closing question to you and more of a short rapid fire question. As you look towards 2030, if there's one policy change that would be enabling for India's fintech ecosystem, what would you see it as and what would you want it to be? And you're the only one who gets to answer that.
One policy change, that's a, that's a hard, that is a very, very hard, because I think there are, look, I think, I know it's very hard to say like one policy change, right? That's a very, very hard thing to do. What I am looking forward to, which I think in a lot of pockets is happening, is just a balancing between both, innovation and regulation and policies. I think, and policy regulation is slightly different space, I would say. And how do you make sure that that happens hand in hand? Sometimes actually both things are hand in hand for the long term. Other times the short term cost can be very high of a policy that comes in. And how do we sort of do the, it's very hard. It's easy for me to say in my position, but as a regulator policymaker, it's hard. But how do we do this sort of analysis of saying, what is the short-term impact of it? What is the long-term impact of it? And I think just, I'm putting that frame in mind for 20, instead of saying, look, one policy, it's that framework to keep in mind. A lot of that is happening across regulators and policymakers where there's a lot of consultation. I think more of it can happen, and that'd be a good thing.
Thank you very much, gentlemen, panelists. I think we had a tremendous discussion, and at the core of that discussion, beyond inclusion, I think the core word that drove this discussion was trust. And it's my genuine belief that in India, when the combination of technology, trust, and good regulation come together, a very sort of magical thing happens. I think it is empowering, it is inclusive. I always say that the dream for anyone in capital markets is that a first-time investor who is probably a house help in tier 2 or 3 India does 100 or 1,000 rupee SIP, remains an investor for decades, and then gives her daughter an education that she never had. That I think is the potential of what we do. There's a quote by Buffett that I like that says that someone today is sitting in the shade because someone else planted a tree a long time ago. And I think as capital markets and securities markets professionals, it's something that we should remember every day, that we don't have just the job of creating wealth, but we have the job of creating wings. And the true success, I believe, of capital markets lies not in what we are and in the numbers and statistics, but in what we will enable people to become. So thank you all very much for being a lovely and patient audience, and thank you so much, gentlemen.
Thank you.
Yes, indeed, a huge round of applause. Thank you so very much, ma'am, gentlemen, for this insightful session. I request you to come together for a group photograph, please. Well, indeed, what an uplifting session here, and I'm sure everybody has got some great takeaways from it. Once again, I'd like to thank all our esteemed panelists.